if companies move here, I think that's good for everybody. But also the other countries could say, hey, we're going to put a higher tariff on your goods, and that hurts any exports that we do. And
Right.
so there's just a lot of unknown other than you're going to have short-term pain. Welcome to a Wiser Retirement Podcast. Are you curious about the current market mayhem? I am Casey Smith. Today I'm joined by Senior Financial Advisor Shauna Theriault. Each week we bring you practical advice on retirement, investing, and planning for your financial future. Don't forget to subscribe to the podcast wherever you're listening. Let's get started. Hello, Shauna.
Morning. How are you?
Doing good, man. Late nights.
Yes. Late nights fielding phone calls and watching reactions and all the things, right?
These are crazy times right now. In fact, this is not even our planned episode. So we decided to throw this out there for our listeners to understand what's happening and tariffs and the markets and everything that's going on. Andrew's working hard, cleaning up some rebalancing that we did yesterday in the portfolios. We'll get to that near the end and why that's important. So you and I have experienced all of this. For me, a little bit of the dot-com burst.
Mm-hmm.
That was when I was coming onto the scene in my career, and then
Same.
they had the financial crisis, followed by a little bit of scary stuff with Enron, followed by so many other things that came after that. September 11th, I guess, is another.
Yeah, I was like, it's the dot-coms, Enron, September 11th, financial crisis, and then COVID, right?
Right.
I mean, there's obviously been dips in there and different things, but these are, so this is another, could be a major one.
Yep.
We were looking at it the other day, and it was like, this is the fourth largest 3-day drop in history.
Yeah, I believe so. I think that's what Andrew had mentioned in passing. Yeah. I want to be like the seasoned captain here that is very calm, and I am, but it's hard to be calm when other people are kind of, starting to freak out a little bit about all this. And so much of this is political, which is something we've been trying to avoid, intersecting politics along with economics. And this is one of those cases where it's definitely crossing, because it was created by a political party and their ideology of what they want to shape America to be, right? And then you have the only other time I can remember this in recent was the last administration, when they really goofed up inflation, right? But specifically gas prices. they were not handling the gas price situation very, very carefully, and people had to pay a lot more at the pump than they had to. And I was like, that's another time where politics and things economics intersect, but it's always temporary. And anybody who's lived a life knows that you go through seasons, and when you're in a season, there's a tendency to think that you're all going to be here forever. This is the way it's going to be the rest of my life, and that's not how it is.
No,
in reality. So
no, I mean, in reality, just in general, it's like you're either heading towards a storm, in the storm, or coming out of a storm, right? And so that's the only thing. We can't guarantee returns. We can't guarantee anything, but what we can guarantee is that something is going to happen. Nobody can foresee it sometimes. Nobody saw COVID. Nobody saw 9/11, so we don't know what's going to happen, but we know that something will happen at some point, and you just have to be prepared for it,
right.
Which we'll talk about that later in the episode.
So first of all, I don't want to assume that anyone even understands what a tariff is and how they work.
I don't think most people do, actually.
But everybody's an expert right now. Everybody's an expert in tariffs. I get a lot of my research just comes from walking around, and I was down at Sun and Fun this last weekend, and that's a huge air show, fly-in air show down in Lakeland, Florida, and I started asking some of the exhibitors, say, hey, how are these tariffs going to affect you? And it was interesting, at least in the aviation side, there's not a whole lot that's manufactured overseas. Now, the Boeing and Airbus are not there. But when it comes to Cessna and Pipers and Kodiaks and a lot of the parts or autopilots and things like that, oddly enough, a lot of that stuff is manufactured here. So I was interesting that interesting, those kind of conversations that they just didn't feel like it would really affect them, other than people being concerned and just not doing anything, not buying.
Yeah.
Because they're
Or people just cutting back on travel and expenses because, watching their portfolio go down or being nervous about things and
correct.
they just cut back. And so that hurts the airline industry, right?
So, all right. So, what are Trump tariffs? So, let's look at it this way. So, imagine that you're buying a toy from a store. Normally, that toy costs $10, but because it's made somewhere far away, like China, where it's cheaper to produce, now Trump says, "Hey, if that toy is not made in America, I'm going to add a $2 tax on it." So that's a tariff. So something coming in from overseas, hitting our markets, and that tariff fee is slapped on whatever's coming from other countries. So Trump is doing this big time. Right now we have 25% extra on things from Canada and Mexico, 10% more on China, which that actually is going to be higher, a 10% baseline on almost everything else imported. So a $10 toy might jump from $10 to $12 to $13, depending on where it's from. So that is that's how tariffs are affecting. Now, if you go to Walmart and something is made in America, that price wouldn't change. And so what it allows us to him to do is level the playing field for American companies, where other other products are getting subsidized or have cheap labor. He's trying to make it fair for companies to be able to compete worldwide.
So the goal is to, I presume, have jobs come back here and have more
Yes,
production here.
correct. So why is he doing it? Main goal first, he wants to bring jobs back to America. He thinks if foreign stuff gets pricier, companies will say, forget it. Stop shipping. We're going to stop shipping from overseas. Instead, we're going to build it in Ohio or Michigan. So more American jobs, basically. More American cars or TVs. Second, I think his goal is to play with, he's playing tough with countries like China, who says he says they cheat on trade. So stealing ideas, undercutting prices, and tariffs are a way of hitting back. I'll add a third. And so part of the problem is our country spends $2 trillion more per year than what it receives in revenue. And the administration has a two-pronged plan, which is to close this budget deficit. In about 20 years, 75% of our tax revenue will have to go just to servicing the debt of our country. That's not sustainable. So that puts Social Security at risk, puts Medicare at risk, puts a lot, road reconstruction, all these things. You couldn't do any of that. Country would be buried.
That's like an individual having like all this debt and their paychecks, they're just going to paying the minimums on credit cards, right? And the interest on the credit card. Eventually, it's like you're not making any headway. Like, so think of it.
You have no money for food, the essentials, right?
Yeah, right. Because the interest rates, going up.
In order to fix this cliff, you do have to have a situation like we have today, where it becomes politically unpopular. You have a one-term president, which essentially right now he's a lame duck president from the very beginning because he's not going to have a second term. So they can't hang that over his head, right? And then in the transition. So the idea is that we apply these tariffs. We would encourage companies to build in America. Then they would eventually move here, and you wouldn't have the tariffs anymore, right?
Right.
Things would be a little more level, but you'd have higher payrolls. So you could get more through the payroll tax theoretically. That's the cart way down the down the road.
But if you have more jobs here and you have more people paying into Social Security, that helps that, right? And then you have more payroll tax, but it's also bringing more jobs here and revenue and workforce and all the things, right?
Correct.
So that helps Social Security in the long run. If more people are working, more people have jobs.
Correct.
Right.
So then the other fold of that is with Doge and Elon and all the drama surrounding that. But if we can cut unnecessary spending by $1 trillion, we can now have a balanced budget. If we get a balanced budget, then what will happen is our credit rating would most likely go up. Credit rating of the U.S. Treasuries have been notched down twice in the last 15 years.
Mm-hmm.
So Trump came in office. The 10-year note was about 4.75%. I have not checked today, but yesterday it was down to 3.98%. So if that keeps falling, then we can refinance some of our debt at a much lower rate. What's happening right now is 60% of U.S. debt in 2025, I believe it's in April, is going to have to be refinanced.
Yeah.
So I'm sorry, 30% of U.S. debt needs to get refinanced in April of this year. So right now, that's all from COVID era. It's near 0% to 1.5%. That's now going to get moved. What was almost 5% when he took office. Maybe that's not a huge deal like on an automobile purchase. When you're talking about trillions of dollars in debt, that is a lot of difference between 1.5% and 4.9%, right?
Well, and not even like comparable, but to compare it to your own household, there's so many people like, hey, I would think I want to buy a house, and they look at their interest rates going from 3 to 7, and it's like, wait, no, I don't. I don't need to move. It's like double. So if you think of, double, that's a huge 5% increase on a huge amount of money. That you're right.
So another thing too is I'm trying to stay away from the sound bites. I'm trying to listen to full interviews. And so anytime I can find a full interview where someone from the Trump administration or someone with opposing views from the administration can talk at full length, then I want to listen to that. And what I find interesting was, I don't know that Howard Lutowitz, our commerce chair, has gotten a full shake in all this. So I listened to a full length interview. I actually sent it to our clients, interviewed by two Democrats two lifelong Democrats that did vote for Trump this last time, did not vote for Trump prior, but they were very disenfranchised because they said Kamala should not have been that candidate. They should have had a quick primary, a fast primary. So they felt like they were being forced to vote for this person that would not have been on the ticket otherwise. And so they also are very smart people that are concerned about this debt cliff. They're also immigrants, so they oppose Trump on some of the immigration policies. But they had a great interview with Howard. And one thing that I got out of that interview is probably about 30 minutes into it. It's the All In podcast. About 30 minutes into it is where it really starts. Howard Lutowitz, by the way, he ran Cantor Fitzgerald. His sons are running it now. Only reason why he didn't die on 9/11 is because he was walking his son to school that day. He lost over 600 of his employees at the top of the World Trade Center. And so he's been a lifelong Democrat as well. And I guess, he lives in New York. Trump was too, I guess, for all sake. In fact, I think everyone in the cabinet, Trump's cabinet, was a lifelong Democrat up until the last few years. But the point of all this is, in the interview, listening to him, they really want to get this balanced budget done. They really want to lower the U.S. Treasury yield. And so they're trying to make America economically sound again, is what the process is. Now, how they're doing it, I think, is crazy, because they're turning the world upside down in the process. And for everyday people, even myself, to follow every possible angle on this is a full-time job in and of itself. And I will say that the media doesn't understand it. Even CNBC, they have guests on that I'm thinking, none of that's correct what you just said. but it's somewhat maddening. I believe that it's temporary, but we already have interest rates lower. We already have cheaper gas. That's a start, I guess, to all this. But anyway, let me get back to our list here, so we don't lose anybody in the process. So how do these tariffs hit everyday life? So it's $2 extra for that toy, right? Remember, we were paying 10, now we're paying 12 for it. Um, but it's also your groceries, your clothes, car parts, anything imported can cost more. Most of the things that I'm reading show that the price creep could be 5 to 10%. Trump argues that you win in the long term. Part of that Luckwitz interview says his deal with Donald Trump's like, "Hey, Trump, I'll help you do this as your Commerce Secretary. But if we achieve a balanced budget, I want you to push forward with no income tax below $150,000 a year. So if you make less than $150,000 a year, you pay no income tax because the country could afford it at that point because we'd have this balanced budget, we'd have tariff revenue coming in. But here's the reality. If companies move here, I think that's good for everybody. But also the other countries could say, hey, we're going to put a higher tariff on your goods, and that hurts any exports that we do.
Right.
And so there's just a lot of unknown other than you're going to have short-term pain. I think it's no accident that they didn't do this till April because most financial institutions kind of work on a quarterly basis. So they're able to get the first quarter through. Why wouldn't they have done this on February or March, April 2nd, because now we have a full quarter to rebound. So these financial institutions are not hit as hard. That's me reading between the lines. No one's actually said that. So if the tariffs also do not cause inflation to continually increase, it causes a one-time bump in inflation. So you could have a tariff implied that product costs more, but that cost of that product's not going to keep rising. It's not like what we experienced for the last 4 years where everything just kept steadily increasing over time, right? Mm-hmm. So, and then it also gets very complicated because if you look at a Ford truck right now, like 45% of it or thereabouts is actually from overseas. It's overseas parts.
Wow.
There's an article in the Wall Street Journal that sometimes a car can cross borders 3 times as it's being made between Canada and Mexico.
You think that's so inefficient and costly?
You would think, but I think the labor is so cheap in other places that maybe it's worth it.
I remember, what was it, like a decade ago when they really started outsourcing labor? I remember it was like a huge shift that happened.
Yeah.
And the plants were being shut down and it was like all of a sudden all of, people that I knew, we started calling call centers overseas and you know what I'm saying? Like, I feel like it was like a decade ago. I don't know exactly when it was, but I remember it was a huge shift where so many jobs went overseas and all of a sudden we were dealing with, people. It's not necessarily bad, but it takes away jobs here. And I remember that and people were laid off. And then, so it's like everyone's worried about the Doge workers, which, obviously, but maybe they'll have more jobs if there's more jobs available here to go to.
Well, the government jobs, I would argue that most of those government jobs, there shouldn't have been people employed there anyway.
Right, so exactly. Government workers still need to go somewhere to work.
They even found that the government has 11,000 Adobe subscriptions and not one single login in the last year. There's so much waste out there. 11,000. I turn my Adobe subscription off sometimes. I'm like, I don't know. I never use this thing as much anymore. I don't have to create PDFs. Other people do that now, right? It's like, maybe I'll just turn mine off. I can save that $25 a month.
Yeah. It's not efficient.
Here's a government that probably paid the most money ever for a subscription times 11,000.
Right.
So there's no doubt that, we haven't really cleaned house since the Clinton administration. The last administration to go through and say, hey, we need to eliminate waste was Bill Clinton and Al Gore. That's how long it's been since we've cleaned house. And when he did it, he and Newt Gingrich are working together.
Yeah.
Where right now, Democrats are not for efficiency and cutting out 11,000 subscriptions that aren't used, which is ridiculous. So it's what's happened is a long time ago. I want to drive into detail. I could have a whole podcast just on this topic. A long time ago, we decided that the World Trade Order was going to be the new thing. The whole world is going to be one world government, maybe one currency, and all these things that people envisioned. And if you look at the budget or the trade deficits across the world, there is no trade deficit. We're the only ones with the trade deficit. Everyone else has a surplus.
Mm.
So what's happened is we spend $2 trillion a year probably on stupid stuff, but at the same time, we are financing the entire world at the detriment to our economy long term. And people don't see that. People think very short term. Can I buy this car? Can I buy this house? Can my kids go to this school? Is my life better than it was a year ago or 4 years ago? Right? We don't think even in personal finances. I mean, maybe at our wealth management firm, people are thinking more ahead, or else you wouldn't come to a wealth management firm. But that's not normal that people have a connection with a wealth management firm. So
Right.
people are not thinking about the consequences of us financing the world for the rest of our lives or for the rest of our country's history. They're going to put us out of business is what's going to happen. It's kind of like having children that never leave home, but are costing you 30, 40, 50, $60,000 a year. And you're like, okay, I can pay this. I can pay this. I can pay this. And then now you're getting older. And now you have some of your own expenses that are coming in. And now you're trying to cover everybody to keep everybody happy. And that's kind of that's the world that we've been operating in. And it's been okay. But we are very close to all this coming home to roost, and it's going to be at the expense of only the U.S. economy. And so that's the part that it's hard as a planner. You see it, but as I think of everyday person, you don't necessarily see that. You don't understand that.
Right.
So that's the problem that's trying to be solved. And I also too, all this is changing very fast, and the news and all this. I don't know that Trump actually is expecting to keep these tariffs on. I believe that there's going to be some negotiations. We already have a long list of people that want to meet with Trump down at Mar-a-Lago. I believe he probably ends up having some type of a summit. Vietnam has already offered 0 for 0, so no tariffs on either side. So that's a now level playing field. That's another thing too in all this is like I've understood finally me. I was late to the game on this one, but you think we have free trade with the world. We don't have free trade. It's not free trade if you have these tariffs.
Right.
So a 0-0 is truly free trade. Now obviously Vietnam, not a whole lot comes from there, but we get a lot from China, and they're the ones that are they don't have a whole lot of leverage in this. Their economies has been tinkering on the brink for a while now, and so I think something will happen. I think positively. I think that today, as we're talking, we're coming off one of the two worst trading days. Futures are pointing higher. I think people are going to realize that this is all going to play out to be in the favor of U.S. stocks in the end. But right now, it's just very scary. I mean, there's going to be short-term pain. We've already experienced that. We have a tremendous sell-off. The S&P is right there flirting in bear territory. Small caps are already in bear territory. Long-term outlook. Long-term outlook is really it's really all over the place. Right now, we've got a couple of prominent people I follow that think that this is the beginning of something that's going to make America just amazing powerhouse, manufacturing powerhouse, economic powerhouse. And then there's 3 other people that I follow that think that this is going to develop into a deeper crash. If you look at, so I'll throw out some names. One, I don't watch his show, but I do listen to some of his commentary. He's a very smart guy, Jim Cramer from CNBC. He's more entertainment at night, but in the morning hour, some of the things he writes have a lot of validity to it. He's always been pro tariffs. He thinks that how the world trades with the U.S. right now is very costly to the U.S. So he's pro. He thinks all this is great long term, but in the short term, we're just gonna have some pain. Like short term, as in like maybe 6 months.
Right.
Jamie Dimon, he's been very supportive of the tariffs, but only apply to certain countries, not this blanket tariff thing. I think what Trump did was basically say, okay, I'm placing these huge tariffs on everybody. You guys think about it, and when you're ready to talk about it, come see me in Florida.
Right. Right.
And that's very like a Trump type negotiating style. Um, Diamond sees a potential of supply chain chaos, maybe persistent inflation potentially, which would drag on obviously our U.S. growth. But he, he sees that how we're currently trading as a national security issue, and that we need to have higher tariffs in order to keep things here in the U.S. in some cases. I think he was talking about AI type things at that point. There's a J.P. Morgan strategist that I follow. He has a bearish warning. He's not predicting anything particularly rosy over the next year. He's worried about a correction, high market concentration, and political turmoil pointing together, meaning the top companies that are in the S&P. He says triggers could trigger a sell-off. This is obviously old news. It's already triggered a sell-off, but the damage could be significant if Trump doesn't blink and negotiate something with these countries. Goldman Sachs has come out with what they call a quantitative concern. Trump's tariffs, 25% on Mexico, extra 10% on China, are not cheerful, as they say. They think it would hit the estimate, or the 5% hit to the S&P's fair value, and with every 5% tariff hike, cutting earnings by 1% to 2% per share. So if that's a 2 to 3% earnings drop, earnings per share drop, and that's how we calculate stocks value, is what the earnings per share is. So they're saying that this is going to kind of could reset the market to be lower. Bill Ackman, he's a hedge fund manager. He is more he's calling it an economic nuclear winter if they persist, suggesting they could tank markets, spark a global recession. Ackman's critique stands out partially because he's not a free trade purist. He's just spooked by the scale and speed. So he thinks the Trump strategy might backfire, hammering consumer prices and corporate profits, with Wall Street feeling the heat very quickly. His plea has been moderation. I hope Trump dials it back. Now, you got to remember where some of this comes from. So when I listen to anything from Bill Ackman, a very large hedge fund manager, he's a hedge fund manager, so he's always going to be doom and gloom, because if he's not doom and gloom, he can't get people to stay invested in his fund, which is supposed to help you in the doom and gloom. So you have to be very careful as you listen to this. Larry Fink, he thinks he's just going to cause a lot of inflation going forward. He's more negative than Bill is. Quite frankly, Larry probably has an axe to grind. Larry's a big environmental social governance guy. He was very heavily involved in the last administration. And I'm not a Larry Fink or BlackRock fan, just because I feel like they duped investors with their ESG agendas, adding millions and more money to their revenue coffers at the expense of shareholders, or the fund holders who bought into those strategies. But he's obviously not big on that. And then UBS came out, the chief investment officer. I would say that she's like skeptical hope. She's skeptical of a prolonged trade war given Trump's obsession with the stock market performance. So she thinks that Trump's so obsessed with what the stock market does during his administration, more so than any past president, that when he sees all this pain, at some point he'll say, all right, we got to stop losing money in the stock market. Her hope is that Trump backs the stocks off before they skid too far, avoiding a deep economic wound. I think I'll also add here that if you look at academia, most academia doesn't support any additional tariffs. And I'm not sure why that is. I mean, academia obviously operates in a vacuum, but you'd have to be able to also see, if you're an economist, you'd have to also see that you can't continue the path that you're going down. So, and you're not going to be able to cut costs of the government. I mean, you just got to give them less money.
Yeah.
Right? We're seeing the pain already. People are burning Teslas because they don't want a balanced budget. They don't like the fact that there has to be cutbacks. So I don't know. It's a crazy situation. I I hope that the Trump administration wins, because if they don't win, there's going to be a lot of this chaos for absolutely nothing in the end.
Right.
So I hope that there's a balanced budget. Um, I don't think that this is much different than any other crisis, though. In the end,
No.
I mean, we still have to solve the 20-year problem. But I don't see this. This is not a different catalyst than COVID. It's not a different catalyst than the financial crisis. When it comes to how you manage assets and how do you win through all this.
Yeah.
If you're listening and you're still working, the last 2 days have been a tremendous buying opportunity, because you're now back to February of 2024 prices.
Yeah.
Which is amazing. You think how much we've fallen in the last couple of days. You think that, oh my gosh, this is horrible. We're nowhere near the COVID bottom. Nowhere near it.
No.
We're nowhere near the financial crisis bottom, which was 6,500 on the Dow. We're still around 37,000 right now.
Yeah.
In fact, Jamie Dimon was saying that he still thinks stocks are still overvalued. Obviously, as we're recording this morning, the futures are up 1,200 points. So other people think that stocks are cheap, right?
Yeah.
But I think that's what I want my listeners to take home is that there are so many opinions on this. There are so many opinions, but in the end, it's no different than where we were with COVID. It's no different than where we were with any other crisis, because there's always varying opinions. And it's how we react to these. So if you're still working, this is an opportunity to buy shares cheaper.
Yeah. And you're dollar cost averaging in your 401k, hopefully. So you're adding money there, but if you have money on the sidelines, add a bit more.
So your dividends get paid by the share, not by the price. So when something falls and you can buy more of it, you're going to get more revenue now in the future because you got a better price.
You got more
shares per dollar, right?
Mm-hmm. Yeah.
And so that's how you have to think about these situations. If you're still building wealth, that these are buy-in opportunities.
Are you curious why annuities keep coming up as a potential investment option? People are often told that annuities can effectively mitigate investment risks and help secure their financial future. However, annuities often benefit the salesperson and might not be the best choice for you as a consumer. To learn more about the various types of annuities, the negatives of owning them, and better investment alternatives, we have a free ebook on our website just for you. To download our ebook, Buyer Beware, Why Do They Keep Trying to Sell You That Annuity? Simply click the link in the episode notes or visit wiserinvestor.com/guides. Now let's get back to the episode.
Well, and some of the questions we get, right, Casey, is, well, I'm retired now, and so what do you do with that? And I know everyone hates to hear this. We stay the course. That's why we put together a plan. So we don't sell stocks when they're down. So, if you're in retirement, the way that we manage money, and many managers do as well, this is why it's important to understand, make sure you're allocated properly during these times. You have a 2-year cash bucket. That's where you're taking withdrawals from your account and you have the money set aside for 2 years. And then on top of that, you have fixed income. And so the way that works is that, you just start spending from that cash bucket. Maybe you have sources of income from Social Security. Maybe you have a pension. Maybe you have rental properties, but you have all this income. And then whatever the shortfall is you're taking from your portfolio. So there's a portion that should just be ready for your withdrawals for 2 years is how we look at it. And then there's a portion that's in fixed income that's not participating in the market. And so if you need to, you then go into the fixed income. So the whole point is that you never have to sell a stock when it's down. So when we go into times like this, because sometimes we don't know when these things are going to happen. What we can tell you historically in Casey's and I career, it's something is going to happen. I promise you, something is going to happen. We don't know what it is, but you have to be prepared for that, either for a buying opportunity if you're still working, or have the money to live off of while you weather a downturn. And so, then you're living off that fixed income in cash. So that way you're not, having to sell a stock. Now, 08 and 09 was different because everything was down, including bonds. And so that's why it felt scarier. I think of all the market short, declines, that was the scariest one. And then you were losing jobs and losing your homes. So all of that was the scariest time, in my opinion. And so this is where we say, okay, stick to the plan. We're not selling stocks when they're down. And when they rebound, then we fill back in those buckets, for lack of a better word. There's also other things you can do during this time. So making a small shift to rebalance a little bit. If you do have money on the sidelines, even in retirement, you have that fixed income bucket I was talking about. Maybe you make a little shift because stocks have declined, and shift a little bit, not all of it, because it's money we want to stay safe to live off of if we go into a larger decline or a longer period of time, like it happened in 08 and 09. But, maybe shift a little bit. There's also taking tax losses. So this is an opportunity in taxable accounts to harvest tax losses and take those tax credits against future gains. So looking at that, and I don't know that it's the right opportunity yet because everyone's doing their taxes right now. And sometimes it's better to see, closer mid-end year, but thinking about when markets pull back, that's my favorite time to do Roth conversions too. If it makes sense for you, that's a very personalized thing. It depends on your other income. Right now, it may be hard to differentiate just because, we are so early in the year and you may not know what your income is going to be for the year. So, but this is those times, as I remember in 08 and 09, it was great making Roth conversions, right? And that's where they lifted the rule where you could spread the taxes over 2 years. And they lifted the income restriction of 100,000. So there are still opportunities, even if you're retired, to take advantage of market decline. So it's not all bad, but the biggest thing is just making sure that you don't react emotionally and you don't sell when it's down because you can't stomach it, because you can never recover from that. This is when we have to say, okay, this is when I know you hate this, stay the course, but this is the reason that we do what we do. And you do stay the course and you wait it out. That doesn't mean you don't make little shifts in between or take advantage of a little things here and there that could make, a 3-5% difference potentially, depending on what you're doing. But you cannot just time the market, because you have to be right twice. If you sell, you have to know when to get out and when to get back in. And I have watched, unfortunately, not at our recommendation, I have watched people turn their net worth into half of what they had just because of an emotional couple day trades.
Yeah.
So it's really truly staying the course. That doesn't mean we don't get worried and we don't like what it looks like it's on paper, but it's having a plan and following through with that plan.
I think when you start moving to cash, at that point, you're just gambling.
Yeah. It's stressful.
You have to be right.
You're going to see, like, it's up, like what? It's going to be up 3% at the open today, potentially.
Right.
Okay. What if you sold yesterday because you were like, oh gosh, I can't stomach this. And now you're missing the upside. You're really stressing yourself out.
If you sold at the open yesterday, you sold when the market was down 1,500 points. Mm-hmm. That's 1,500 points. Within the first hour, it was up 430. Mm-hmm. And it closed kind of flat. But then, if today holds, we'll see what happens. But it's
a long-term investment.
You have to be right on the exit, and you have to be right on the re-entry.
Right.
A lot of people in late 2009, 2010 that had $1 million, and now they had $500,000. And if they had left their money in, they'd have $1 million.
Mm-hmm. Yeah, more than at this point.
It's at this point, yeah, absolutely.
Yeah. I mean, so it's like,
so what's happening is that people are getting their politics mixed up with their portfolios and what works long term. Mm-hmm. There are certainly day traders that can be successful in all this volatility. We're not day traders. We're in charge of getting the client to age 95 without running out of money. And I hate losing with a passion. And so what we do is we look at probabilities of success. What's the probability of success if we go to cash and we're going to re-enter at a certain point? Your probability drops tremendously.
Yep.
And so it's how you have to build this is, you talked about the cash bucket, but also you have the cash bucket. That's your 2 years worth of expenses. But then you also have the bond market, mm-hmm. which flat. Well, actually it's up 3% right now.
Yeah.
So you have the bond market. So if you needed money between your cash and the bond allocation in your portfolio, you could probably go a good 10 plus years.
Yep.
And then we know over a 10-year period, we know the worst case scenario that ever happened in stocks was flat. That's the worst case.
Right. There was 2 time periods where it didn't recover in 10 years and it was 11. So, I mean,
Right.
really, but normally market recoveries are much shorter than that.
Yes. Less inside 2 years.
Right.
Yeah. Or in COVID, it was like 3 months.
So if you have the 2-year cash bucket, that should get you through. But just as you said, you can always go into the fixed income without still having to sell stocks. And even still, during some times, there's periods of recovery where you could take some off the table and fill it back in.
Yep. Correct. And so it's people just focus on that balance dropping, and that's human nature. And I totally get it. I do the same with mine. I'm like, man, I was up to this point. Now I'm all the way back to this point.
Mm-hmm.
But that can get you very short-sighted. It's like walking down the street, only looking at your feet. You're going to run square into a pole at some point and probably show up on someone's YouTube channel or social media post, right?
Mm-hmm.
You don't want to do that. You want to walk down the street looking out, and it's hard. It's hard to do that. And honestly, that's why people hire advisors to manage their assets, is because they want people to talk sense into them. So many of my conversations I've had in the last couple of days have been, this is your plan. This is why it's still working. Our plan always assumes there's a financial crisis. We're nowhere near anything like that right now. Mm-hmm. And if you get a rebound in the market, then you get another one. And so logging into some of these financial plans that I've seen didn't change the percentage probability success one single bit.
No.
Change it one single bit. We've had some people add more bonds to their portfolio because they were nervous about some things that are happening. I firmly believe that they'll regret that in 10 years if they stayed in that allocation. You can add more bonds, you get more conservative even before this happened. But in 10 years from now, when you look back at your performance, you're going to be really disappointed.
Yeah.
And so it's really, it goes back to, it's not even emotional for us. It comes back to math. If you have this much in stock, if you expect this much volatility, where does that get me in my probability of success long term? And so for most retirees, that's why a 60-40 portfolio works so well. If you have excess wealth, you can go to 70-30 to get that higher rate of return. If you're a nervous Nelly and you can't sleep at night, then that's a little different ball game. That's why we have more conservative allocations, because your makeup as a person is not able to handle this. So you were already in majority of bonds before this even happened anyway, because you couldn't handle little hiccups, and that's fine. And there's portfolios built for you. But when you start making knee-jerk reactions based on political news and based on what's happening in short-term volatility, it never ends well. It never ends well. I've met a few people in my lifetime that said, "Oh yeah, during prior to the financial crisis, we just sensed there was something up, so we went to cash." But they were still in cash when I met them 10 years later.
Right. Because it's like they never went back in and didn't know when to get back in.
Yeah. It's like all the doomsday analysts. Yes. At some point you will be right. At some point the market will sell off 10 to 20%. And you know what? That's a little healthy. It's, for people who know anything about gardening, and which I don't that much. I know I'm supposed to prune things, right? If things go crazy, it looks pretty. Yeah. If I don't prune that tree every year, then it's not going to look good for the long term. And that's a lot what market sell-offs are. It keeps the greedy people out. All the people who borrow money to invest, they have to cover that at some point.
Well, and I would argue if you're in cash, inflation is going to eat you alive. You're negative returning anyway, especially if it's in like a retirement account, because then you take a distribution, you owe tax on that, and then you have inflation and the cost of things going up. Well, you're in a negative return situation anyway. So that's not a good position to be in either.
No, it's not. It's not. So I think that, the criticism of financial advisors in these times, like they didn't do anything. They just told me to stay the course. And you know what? I get the emotional comment, the emotions from that comment. But the best thing to do is stay the course. And if you've done a plan properly, you have enough cash to be able to withstand having to use your investment money. Mm-hmm. And that's what advisors are for. Good advisors are telling you to stay the course. The advisors is to say, we're going to change your portfolio. Those aren't good people. Those aren't good people, because they should have changed your portfolio beforehand, because they should have known your risk tolerance.
Right.
Right. So it's people's, it's the movies and the hype and CNBC and all these other shows that people are buying and selling. I'm going to sell this. I'm going to buy this. And it sounds really cool. That's not how you win long term.
No.
And the stats show that. The stats show that 96% of these active managers do not beat the market. And so the best thing you can do is buy the market, get your allocation right. And that's what the planning process is about. So this is when we go back to our plans and we look at our plans and we say, you know what, we plan for this and it'll be fine. People who are about to retire, you're probably okay too, because you're probably not sitting in 100% stocks.
No.
You probably already have a bond allocation, and that's how we can start that cash bucket is building off that bond allocation. You'll be a little more heavy stocks until the recovery starts. Once the recovery starts, you take those gains in stocks and you finish building out the retirement portfolio completely. Yeah. There's no reason to not retire. A simple thinking will cause you not to retire because you'll just calculate something off that balance and not really put it all together in a true portfolio and how this is going to look long term. You can't think simply about this. You have to have a little more understanding of portfolios and market, how portfolio construction and market long-term performance. But I go back to any young person. I mean, I texted on my kids. I mean, they're all 19 years and younger, but I said, go to your green light cards. Today's the day you move some allowance money and you move that into the stocks. Today's the day. Today's the buying opportunity.
Yep.
There'll be millions of dollars by the time you're 65 years old at this point.
Absolutely.
So I don't want to make light of the situation. I understand that our client base is probably split 50-50 between Democrats and Republicans, but the national debt is a bipartisan issue. And we have one party right now that's trying hard to derail us from an opportunity for this country to be better for our kids, financially speaking, in the future. Doesn't mean that in the future that they go back into debt, but man, what a great opportunity to kind of do a reset. You know, no one talks about when Trump 1.0 was in, it was during his impeachment. So that none of this really got covered unless you followed economic papers, but he tried to refinance our entire country debt at 1 to 1.5%. And if that had happened, we wouldn't even be in this situation right now. It'd be a very, very, very different situation. We still have the budget deficit, but we wouldn't have national debt climbing the way that it is. So there's crazy things that man does. Not all of it that I would get behind, but understanding the debt issue seems to be something that he's after. And as a planner, I support not spending more money than you make.
Yep.
But there are a lot of people out there. They're all fired up about this. And I don't understand why people think that you can keep spending $2 trillion more. I don't get it. I don't get it. Even from our own client base, I've gotten some
math isn't math.
I've gotten some emails from our own client base that don't support a balanced budget, and I don't understand it. You'd be in my office crying at my table if you were running hundred thousands of dollars of cash flow every single year, and you saw an income and you didn't know what to do about it. I just don't get it.
Yeah, and your plan fell off like this. You know, it's completely. You don't make it. You run out of money. You know what?
Yeah, I know. I don't get it.
We would be very worried for you. Yeah.
So yes, the answer is how are you going to handle this? Hopefully you've had a plan through Wiser, and you're going to stay the course. And we did rebalancing starting yesterday. If this plays out, if this is near our bottom, we'll actually would have hit it. We were within 4 days of the bottom during COVID when we did our rebalance. I added 3% to the rate of return to all the portfolios that year because we rebalanced near the bottom. I don't know if we got the bottom. There is so much more drama to be played out. I'm looking up here now. The S&P's up 2.4%. Open starts a little bit, but it probably won't stick if history says anything. There'll be more drama. We're gonna bounce around down here somewhere, but quite honestly, this all started breaking out. I guess last Thursday and Friday, and I'd already planned my trip down to Sun and Fun, and I spent Saturday and Sunday down there. And it was just a reminder to me that you know what? Sometimes it's best just to turn the TV off and walk out and go do your life. Just go do your life. If you're not invested in individual stocks and you're sticking mostly to the S&P and index funds, go do your life. Don't let the situation steal your joy. If you feel like it's hitting your career and your business, go work in your business. Go figure it out. Go figure out how to solve the problem. But otherwise, for normal Americans, go do your thing.
Yeah,
it's going to be okay.
It will.
And if you're young, bye. All right, Shauna, good conversation.
Yeah, thank you.
Thanks for listening to our podcast. If you want to reach out to us or comment, you make comments below wherever you're listening. Be sure to also check out our YouTube channel, A Wiser Retirement, and we'll see you guys next week.